As we begin Intermediate Accounting 2, we're going to start with chapters 10 and 11 on property, plant, and equipment and intangible assets. For the most part, we pick up where we left off from Intermediate Accounting 1. If you recall from Intermediate 1, we started out with talking about just what accounting is and the various institutions and organizations that and processes that result in what we call generally accepted accounting principles. Of course, then we covered GAAP, the GAAP conceptual framework, then we worked on some pretty basic problems, recording transactions and summarizing those, producing financial statements, and then wrapped up by talking about the closing process. Then we began looking at specific types of assets, cash and receivables, inventories. We continue that process now by covering property, plant, and equipment, chapters 10 and 11 in your textbook. PP&E represent long-lived or long-lived tangible assets. By that it means that they're going to last longer than or provide service to us longer than 1 year or the normal operating cycle of the company. These are assets used in the company operations, that is to produce income, and not held for resale. It's kind of an interesting thing that, for instance, a Caterpillar D10 tractor represents inventory, a short-term asset to Caterpillar. But it represents a long-term asset, a productive asset in the hands of, say, a farmer or a construction company using that tractor. The first category of PP&E we consider is land. Land is shown on the balance sheet at its original cost. That original cost will include a number of things: the original purchase price, but also any title and legal fees that are incurred in order to secure title and prove ownership of that property, site preparation cost. There may even be a circumstance where you have to tear down an existing structure, and that adds to the cost of the land. As it turns out, any salvage value you receive from the sale of that will offset that or be used to offset that cost. Land improvements are generally charged to the land account as well. However, if those improvements have limited lives, things like driveways, fencing, parking lots, certain types of maybe drainage systems, they should be charged to land improvements but depreciated over their useful lives. Land itself is a unique asset in that it does not depreciate. We don't reduce the cost of land through depreciation like we do buildings and equipment. Buildings and equipment are shown on the balance sheet at original cost less accumulated depreciation. The original cost again includes purchase price, title and legal fees, installation costs, shipping costs, sales taxes, for instance, if you have to, or other types of taxes you may have to pay in order to acquire those buildings and equipment. Those are all costs that are, as we say, necessarily incurred in order to purchase or obtain ownership of the asset. Accumulated depreciation, we'll recall, represents a contra asset account. A contra asset account is one that's associated with an asset account, a particular asset account, but has the opposite balance. Otherwise, it has those same features as an asset does. Remember those features of a financial statement element where we identify the element, an asset, for instance. The normal balance of an asset is debit, but for a contra asset it's credit. They are both real as opposed to nominal, and they both appear on the balance sheet. Accumulated depreciation represents the sum total, the cumulative total of depreciation expense that is recorded over the life of the asset, that is, since it was originally put into service. Depreciation expense itself is sort of an oddball expense. Unlike most other expenses, it doesn't correspond directly to a particular cash flow. You know, with most types of expenses, salaries and wages, for instance, taxes, advertising expense, legal fees, across the board, even inventory purchases, they correspond to a cash payment at some point. Depreciation expense, on the other hand, doesn't really correspond to a cash payment in the period in which it is recorded. It represents really an allocation of the cost of the asset. We're taking the cost of that asset and we're more or less saying, that asset's going to last more than 1 year, so we need to somehow show that it's going to be used up over its useful life. It's going to contribute to the production of income, but in so doing, it's going to waste away or be consumed. And so, as we'll see, we have to make some judgments. We have to make some judgments about expected or estimated useful life. We have to make judgments about salvage value. And we also have to select from among, maybe arbitrarily select from among several options with regard to how we depreciate it. Straight line, or maybe by units of production method, or possibly by one of several choices among what we call accelerated depreciation methods. What we need to look at and be able to handle are all the recordable events, the entries related to the acquisition of the asset, its operation, which would include depreciation of the asset, routine types of repairs and maintenance, and also modifications. There's a difference between those, as we'll see. And then finally, disposition of the asset, whether it's through retirement or whether it's through the sale or even exchange for other assets. Each of those is going to present its own special challenges to us. When we acquire an asset, we will record it as land, buildings, equipment at its cost. Cost is measured as the cash or the cash equivalent value of what's given up in order to obtain the asset. This cost is the basis for all subsequent transactions, for example, depreciation or disposition of the asset. Here's an example we'll walk through. Hoplite Industries purchased land for $145,000 plus $600 for legal fees associated with obtaining the clear title and deed. It then spent $20,000 to remove an old structure on the property and another $4,000 to grade and level that property. The company issued a note payable for the cost of the land and improvements. In other words, at the time of the purchase, there was no cash exchanged. And so we want to show the entry to record the purchase of that property. Given this information, the entry to record the purchase of the land is to debit land for $169,600 and notes payable for that sum as well. The $169,600, of course, is made up of all these items we've looked at: the purchase price, legal fees, the cost to remove an old structure, in other words, to prepare it and make the land useful for our purposes, and another $4,000 to grade and level the property. So all of those costs go into the recorded cost of the land. So those costs include all costs necessarily incurred in order to bring that asset to the place and to the state for its intended purposes, that is, for the purpose for which we have intended to use it. For buildings, machinery, equipment, furniture, fixtures, it also includes things like shipping, insurance during shipment, site preparation cost, installation costs, and all of those kinds of things. Now, if it so happened that let's say we buy a piece of equipment, but in shipping or in installation it's damaged, those costs are not necessarily incurred. They were accidents, and so they would be charged to a repair expense of some kind or a loss. They don't really add to the value of the property. They're simply restoring it because of some accident that occurred. Self-constructed assets are a big issue in this chapter. We'll only get into some of the basics of those. But if a company is building, for instance, its own offices, maybe it's a construction company, or it's serving a company serving as a contractor and having the work done by someone else, we'll have to include among those costs of the assets allocated overhead, possibly interest costs that are incurred during construction. Depreciation is the means of expensing long-lived assets. Depreciation for accounting purposes isn't the same as it is for economic purposes. You probably have heard something along these lines, that when you drive a new car off of the lot, it depreciates by 15% automatically. Well, what that means in depreciation is a loss of resale value, more or less what we might term an economic or market loss. Depreciation from an accounting perspective is actually an allocation of the cost of the asset over the periods in which it will provide benefits. This allocation is required by the matching principle. There are two basic approaches to calculating depreciation: activity-based approaches, which recognize expense based on the use of the asset, and time-based approaches, which recognize the expense based on the passage of time. Within the time-based approaches, there are two basic categories. First of all, straight line depreciation, where the same amount is expensed every period, and accelerated, where greater amounts are expensed in the earlier years of the asset's life and lesser amounts in the later years of that asset's life. Here's an example. Let's assume that a purchase of equipment has taken place. The cost is $135,000, installation costs $12,000, the shipping and insurance cost of $3,000, and the asset is put into service on October 1st, 2017. Now the machine, let's say, is expected to produce 2 million units over its useful life of 5 years, and its estimated salvage value is $10,000. Well, first of all, let's see how we would depreciate this asset according to an activity-based approach. The most common one is what we would call a units of production approach. We figure the depreciation expense on a per unit basis, that is, per unit sold, or per unit produced and then sold. And so we'll figure out that depreciation expense per unit, more or less that depreciation rate, by taking the cost of the asset less the estimated salvage value. And that difference, by the way, represents what we call the depreciable base. And then we divide that difference by the number of units of production, in this case the 2 million units. The depreciation rate, therefore, would be 7 cents per unit, given these numbers. And so let's suppose that as of December 31st, 2017, that's the end of the first year of use of this asset, 350,600 units were produced. The entry to record depreciation expense, given this information, would be a debit to depreciation expense of $24,542 and a credit to accumulated depreciation - equipment of $24,542. Now notice that $24,542 is the product of 350,600 units times the 7 cents depreciation rate per unit. And by the way, and let's look forward just a little bit to something, a situation we're going to run into with any of these methods. Realize we're dealing with estimates here. And so what happens if maybe 2 years from now you realize that that 2 million units was either an underestimate of reality or an overestimate? Well, what we would do is change that, that is revise our depreciation rate based on the remaining depreciable base divided by the remaining number of estimated units of production. We wouldn't try to go back and correct that because it's not a mistake. We're dealing with estimates here, and we know that those are subject to change. So we deal with that not retroactively, but we deal with that revision prospectively. We've seen that before, and we'll see it again. Now let's look at depreciation by the time-based approaches. First of all, by very commonly used straight-line depreciation. In this case, we figure the annual depreciation expense, we could also call it a rate in a sense, which represents the difference, once again, the depreciable base, cost minus salvage, divided by the expected useful life, this time in years rather than units of production. The annual depreciation rate would be, we see here the depreciable base of 140,000, divided by the 5 years that was provided in the original narrative, $28,000 per year. As of December 31st, 2017, the entry to record depreciation would be, let's keep in mind that the asset was not put in service for the full year. We would debit depreciation expense by $7,000 and accumulated depreciation equipment for $7,000. Where does that number come from? Well, a period from October 1st to December 31st represents 1/4 of a year. And so the $28,000 an annual amount times 1/4 would give us the $7,000. Let's take this just a step further and look at how this would be presented in the balance sheet. Given this information here, we would show equipment of $150,000 for this asset, less accumulated depreciation of $7,000 as of December 31st. So the equipment net of accumulated depreciation would be $143,000 at the end of fiscal 2017. Well, let's say the firm continues to operate the asset throughout 2018. And so the entry to record depreciation at the end of 2018 would be this. We have a full year of operation, and so the full $28,000 annual depreciation would be charged. We would debit depreciation expense, credit the contra asset account accumulated depreciation, and given that, what would the presentation of the asset be in the balance sheet as of the end of 2018? Well, it would look like this. The equipment, $150,000, less accumulated depreciation. Of course, that's the sum of the $7,000 depreciation in the first partial year of the asset's operation, plus the $28,000 in the full second year of the asset's operation. And so we end up with equipment net of accumulated depreciation of $115,000.